So now let's proceed with business income. So I want us to look at taxation of petroleum companies. So we are still using the same notes we're using in our last session. The one under the topic taxation of sole proprietorship and partnership. We're using the same document. Yeah? Now the last pages, that's why you have taxation of petroleum companies. So I want us to discuss on something there. So how do we tax the petroleum company? Now, petroleum company are so now let's go through that. That this is provided for in the ninth schedule of the Income Tax Act. We have some terminologies there. Number one, it's an affiliate. Now, what do you mean by an affiliate, or who is an affiliate? Now, this means a person directly or indirectly controlled or controlling or being controlled by or under direct control of another party. So that's what we call an affiliate. Someone who is controlling or being controlled by another party is known as an affiliate. Then we have what we call intangible drilling costs. Now, for petroleum company or extractive industry, intangible drilling costs are what we call operating costs, such as cost of paying salaries, wages, all that. That's what we call intangible drilling costs. Those costs with no salvage value. Now, this means an expenditure that has no salvage value, including the expenditure on labor, fuel, repairs. So in short, it's all about the operating costs. And then number three, we have petroleum agreement, and this means a contract or other arrangement between the government and petroleum company entered into under the Petroleum Act. Then we have petroleum service subcontractor. Now, who is a petroleum service subcontractor? Now, this means an unresident who offers service to a petroleum companies in Kenya. Now, for example, assuming that we want to drill some petroleum products in a given area, we hire someone maybe from UK or from China. Now, that's what we call a petroleum service subcontractor. Number one, must be an unresident, so it's not a Kenyan resident. So you think that this means an unresident person who provides services in Kenya to a petroleum company. Then we have petroleum expenditure, and this means day-to-day expenditure on the operation of petroleum company, but does not include other deductible expenses. Also, you have production. What do you mean by production? That's what we have already produced. Yeah, so this means the quantity of petroleum produced, saved, and not used in the operation to which the petroleum company is entitled under the petroleum agreement. Then we have what we call qualifying expenditure. Now, what is qualifying expenditure? Now, for extractive industry, qualifying expenditure means capital expenditure. That means capital expenditure. That means expenditure to buy non-current assets. So saying that this means capital expenditure other than intangible drilling costs incurred on the petroleum, on operation of the petroleum, on number one, on planted machinery, furnitures, also pipeline and tax, including expenditure, also the construction of industrial building, also erection of bridges and tax assembly in Kenya, acquisition of right of a petroleum deposits, then searching and testing of petroleum deposit in Kenya. So it means a capital expenditure, both tangible or intangible assets. Then we say that for assets, you claim for capital allowance or for investment allowance. Now, for qualifying expenditure, they also qualify at the rate of 50% first year. Yeah, so can you go back to your past paper? The most recent. Page 1, we look at the capital or investment allowance. Look at the investment allowance. Now, starting with part A, where you have the buildings, We have bullet number 4, under the building. Yeah, we have petroleum or gas storage facility. So for the first year, it's 50% for the first year, and then 25% per annum on residual reducing balance basis. Also, if you go to part B of the machinery, part B, where you have the machinery, the second last bullet there, it's machinery used to undertake operations under prospecting rights and exploration under mining rights. I would say that petroleum industry is the same, is under extractive industry. So any other, that means the cost of tanks, pipeline, all that would qualify at the rate of 50%. You see, it's 50% for the first year of use, and then 25% reducing balance on the residual value. We go back to our notes. Now let's look at some allowable deduction under petroleum company. Allowable deduction. Number 1, intangible dwelling costs. Remember, I said that intangible dwelling costs, they are more of operating costs, therefore they are allowable. Geological and geophysical costs, executive and general admin expenses, production expenditure, management fees, interest expense, then capital expenses on qualifying expenditure at 50%, then on a straighten. Now, can you cancel straighten? Just write 50%, but that one you don't have to cram because you already have the schedule. It will be given the table. So it's 50% for the first year, and then 25% reducing balance on the residual value. Then number 8, another allowable expenditure is payment to the government or agency as per petroleum agreement. Good. Now I want us to do an illustration. I think we have all what we wanted. November 2015, question 4C. November 2015, question 4C. November 2015, question 4C. So we're told that Leeds Drilling Limited is a mining company dealing with petroleum products. During the year ended that 1st of December 2014, the following details were extracted from the company's financial statement. So we have geological cost, exploration drilling cost, we have acquisition cost, lifting cost, lease operating cost, cost of refining crude oil, oil and natural gas revenue, depletion and depreciation, share-based compensation, general admin expenses, reversal of litigation expenses. We have finance expenses, decommissioning cost. Then we have the drilling machines, investment income, impairment losses, intangible drilling cost. We have professional fees, loan repayment, tractor, derivative oil losses, restructuring expenses, and then we have forklift. Now, the information given, that's trial balance. So it's an extract. So therefore, it's an incomplete record. So it's upon you now to determine the taxable income, you raise allowable expenses. Additional information. Number 1, intangible drilling costs include for 20 for a well which failed to yield crude oil and was abandoned. So will that be allowable or disallowable? That still is allowable. If you incur some expenditures, for example, you open a business, of course, a customer, now ulipe rent. We do say that you paid the rent and you didn't have any customer. So that comes and it's still a part of operating cost. So because it was intangible drilling cost, so that one is allowable. Number two, restructuring expense include 582 paid to a consultancy firm for restructuring the capital structure of the company. Now that's a disallowable expense. It was capital restructuring cost. Therefore, it's a capital expenditure. It's not a day-to-day expense. It's a one-time expense, so therefore it's a capital expenditure. Number three, exploratory drilling costs include plant and machinery, erection of ridge and tankage, pipeline storage, factory and building. And that's what we call now qualifying expenditure. So qualifying expenditure, you claim for investment allowance at the rate of 50% for the first year. Professional fee include 800 for service provided by the general manager of the parent company. Professional fee include 800 for service provided by the general manager of the parent company. This is a company. So they recognize that the service was provided by the general manager of the parent company. So that means it's not part of this company. But you see that in case of companies, in case it was a partnership, the partner, one of the partner provided services, that's when it becomes a disallowable expense. But this was provided by a professional from the parent company. The two companies are different. So in a transaction between the parent company and the subsidiary will be considered as a business-to-business transaction. So still it's a allowable expense. Required statements showing the taxable profit or loss for the year ended that 1st of December 2014. So this is weeks. So computation of taxable profit or loss. For the year ended 31st of December 2014. So you only had one income. Can you see that income? There was oil and natural gas revenue. Oil and natural gas. Which was an amount of 98,40,000. Did you have any other income? Which other income did you have? Investment income is part of specified sources of income. It's not an operating income. So expenses. So for the expenses, number one, you have geological cost. Geological cost is an amount of 84,680. Then you have exploratory drilling cost. Exploratory drilling cost. 146,400. Then you minus. Let's go to note number 3. Can you add the total of note number 3? Add the total in note number 3. Add the totals in note number 3. You get 64 to 80. So deduct that. This was a capital expenditure, which will qualify for investment allowance at 50%. Sorry? 82,120. Then you also had acquisition cost. So acquisition cost is 19,800. Then we have lifting cost. Lifting cost is an amount of 12,600. Lease operating cost. So the lease operating cost is an amount of 64,780. Cost of refining crude oil. Cost of refining crude oil is an amount of 18 to 40. And then we have depletion and depreciation. That one is a desirable expense. Share-based compensation. That is all about the issue of shares. So that one is a desirable expense. It's a capital expenditure. General and admin expenses. That is allowable. General admin expense. It's an operating cost, an amount of 78, 340. Reversal of litigation expenses. So we have litigation expenses, an amount of 96.80. Finance expense, that's the interest cost. Finance expenses, an amount of 6,400. Decommissioning cost is a desirable expense. Do you know what's a decommissioning cost? That's a capital expenditure, or what we call the end cost. The site closure cost. So, and that one is always deemed to be a desirable expense. It's not an operating expense. It's a one time. For example, you had a project for 5 years. Yeah. Maybe you had a quarry, because most of the decommissioning costs it happens to the extractive industry. You had a quarry. Umetoa mawe. Ukishamaliza mawe unafanya nini? Unashanga tu shimo ikiwa hivyo. Sometimes you may incur some cost to prevent any damage that may occur, such as putting a fence. Now that's what we call site closure cost, and what's called the decommissioning cost. Good. Yeah, therefore it's not allowable. It's not a day-to-day operating expense. So therefore it's a capital expenditure and it's a desirable expense. Drilling machine, that one is part of qualifying expenditure, will qualify for wear and tear. Investment income, specified source of income. Impairment losses, desirable expenses. Intangible drilling cost. Intangible drilling cost, an amount of that, 420. Then we had professional fees. Professional fees was an amount of 26. Then you minus note number 4. Okay, that no, that one on adjustment, that's okay. I remember I explained that. Loan repayment, and that's not an expense. If you pay a loan, that's not an expense. The interest on loan is the one which is an expense. An expense, yeah. Tractor, that's an asset. Derivative oil losses. Derivative oil losses. Yeah, to them, the oil is their asset. It actually is their stock. So in case of movement in prices, so to them becomes a normal day-to-day expenses. So 480, an operating expense. Restructuring expenses. Restructuring expenses, with an amount of 848. Then you minus. There was a capital expenditure incurred. Number 2, restructuring expense include 582 paid to a consultancy firm that restructured the capital structure of the company. 582. That's a capital expenditure. So how much will be the allowable expense? 260, 266. Then we have forklift. So you're done with all operating expense. So now let's claim for investment allowance or capital allowance. Capital allowance on qualifying expenditure. Can you see drilling machine? Yeah, drilling machine. It's 50% for the first year, which is an amount of 18. Yeah. 18,300, that is 9,150. Then there was qualifying expenditure. Qualifying expenditure. That is note number 3. You take 50%. Here was the total. This is what you eliminated here. The total you had added was 64 to 80. 64 to 80. And that is that 240. 25. Good. So 25%, 25%. So tractor is an amount of 1,500. We also had forklift, 1,800. 750 divided by 2, get 3. Is that 375? This is 400 and 450. And that's how you get your taxable profits. As you get the taxable profit, you add other incomes or other specified sources of income. And we had one. What did we have? We had investment income. Investment income. The investment income was an amount of 464. 464,000. And that's how you get the adjusted taxable profit. Adjusted taxable profit. Good. So you can look at that for a few minutes, then we try another one. We do another one. November 2018, question 4A. November 2018, question 4A. You don't have to copy the workings already in your notes. There's no need to duplicate. November 2018. November 2018, question 4A. Question 4A. Mafuta Petroleum Company Limited has provided the following details for the year ended that 1st of December 2017. So you have the sale of crude oil for exports, sale of natural gas, other incidental income, production expenses, intangible dwelling costs, non-productive rentals. Is it allowable or disallowable? Yeah, it's allowable, non-productive rentals. Also, they are part of allowable. Yes. Then we have royalty on exports. What about royalties on exports? Royalty on exports. That's allowable expense. Now, this is what happens. Now, for example, there's a question I like asking. Can you start a Shell or a Total? Can you start? You as an individual, can you open a petrol station by the name Shell or Total? Yes. It's a franchise business, right? Yeah. So what happens? You'll be paying royalty in return? In returns. So that means royalty is an operating expense. Yes. Yeah, it's like, for example, opening a KFC. Can you be able to open a KFC? Kama huyo mzee alitoka Amerika akakuja akafungua branches, anafunguanga branches in Kenya. That's their franchise, Yeah, you apply for them, they give you a license, you meet their standards, you'll be given a license. Now, in return, since you're using their name, they have established the brand name. You'll be paying in return what we call the royalty. So that means the royalty, the one you're incurring, it's allowable expense. It's good. Yeah. So we have royalties on exports, royalty on local sales. Kindly, these are an extractive industry, so some terminology might change. You know, from other business perspective, you know that loyalty is a specified source of income. So to this petroleum company, they want that pay because of using the name maybe of another to be given a license for them to operate under the name of another entity. So therefore, it's allowable. Then we have provision for restoration of a well. That is disallowable. It's a provision. We see that all provision are disallowable expenses. Custom duties on plant and machinery. Custom duties. That's a disallowable. That's actually, that should be capitalized. It's part of capital expense. It's like, for example, importation cost, all that. VAT. Those are the costs charged when you import a product from another country. So that cost will be incurred prior to you receiving the asset. So it's a preliminary expense. Additional information is provided. The following additional information is provided. Memorandum of Understanding, credit 18150. That one is an expense. An expenditure. Yeah, when you're entering into MOU, there is some cost you have to incur. So that one becomes a what? allowable expense. Then petroleum investment allowance has been agreed at 13,612. Petroleum investment allowance, that one is allowable expense. It reduces your taxable profit. Number 3, depreciation included in production expense amounted to that 6,300. Capital allowance agreed with the revenue authority amounted to 54,450. Required a statement of taxable profit or loss for the year ended that 1st of December 2017. So this is Mafuta. Petroleum Company. Computation of taxable profit or loss for the year ended 31st of December 2017. Now let's start with the incomes. Now for the income, we have sale of crude oil export. Amount of 834,900. Sale of natural gas. Amount of 43,375. Other incidental income, that's what we call other operating income. Other incidental incomes, amount of 45,37.5. Then we raise allowable expenses. Allowable expenses. Number 1, there is production expenses. Production expenses, an amount of 217,800. Note number 3. Note number 3. Number 3, we are told that depreciation included in production expenses amounted to 36,300. So you minus 36,300. Depreciation is a desirable expense, which was included in the production expense. So how much is the desirable one? Sorry? 500, eh? 81,500. Then we also had admin cost. So administrative costs, we have an amount of 9,400. Intangible drilling cost. So for the intangible drilling cost, an amount of 45,375. Non-productive rentals, so that one is allowable. $18,150. Royalties on exports. Have an amount of 45,37.5. Royalties on local sales. And then sometimes royalty is not a must that you are paying to the owner of the name. Also, you might be paying to the government, because this is where the government gets a lot of revenue. For example, if you buy a 1 liter at 177 shillings. Now the benefit, okay, most of this cost goes to the government, right? Together, most of that money goes to the government. There is a lot of taxes there. So that means the petroleum company will be acting like an agent. They are collecting on behalf of the government, of which they need to remit back to the government. Yeah. Then we had provision of restoration of oil. That's a desirable. Custom duty on plant and machinery. That's a preliminary expense. Number 1, memorandum of understanding credit 18,150. And what's MOU? Now, MOU mostly it's an amount which be out of which the objective is to attract investment in petroleum industry. That's the measure of having an MOU. So MOU create an amount of 18,150. Then we have petroleum investment allowance. So we have investment allowance. An amount of 13,612.5. And number 4, capital allowance agreed with the revenue authority. We have capital allowance. They agreed an amount of 54,450. And that's how we get the taxable profit. That's how we determine the taxable profit. Then number 2, the tax liability. How do you get the tax liability? Now, tax liability, you just take 30% of your taxable what? Of the taxable profit. Number 3, explain the significance of memorandum of understanding in petroleum industry. Why should you exempt that amount from paying tax? Now you're saying that I have mentioned that. What's the importance of having an MOU? Okay. Yeah, to attract investment in petroleum industry. And that one mostly, how do the government are much interested in petroleum industry? Petroleum industry, if you want to set up a gas storage facility. Also, if you have a company that want to establish a big manufacturing company that will employ more than 50, why is the government interested? So anything that will be of beneficial, much beneficial to the government, at the inception stage, there is those benefits that they get. For example, if you get an investor who want to invest like 3 billion. Now, the first question is, this 3 billion, how will it benefit our country? We employ 1,000 employees. So from that, unapatanga they are given a lot of incentive at the inception to encourage them to come and invest. So the same thing happened to the petroleum company, because you see that those are the major avenues that the government used to collect revenue from the petroleum products. I'll look at that for a few minutes. Then I do another one. Perfect. So now here there is a question. I was looking at some of the online questions that rent expenses should go to other specified income to be offset against rental income. No, there's a question we did whereby we are offsetting. There was rented property expenses. Now, if we pay rent here, that one does not mean you have rental income. Are you together? Yeah, so the rent you're paying is the business you're operating. That's what we call the rental income. Yeah. But the question we had done previously, where we had rental income, and then there was rental property expenses. Now, those expenses, the one we had to offset. That one was not rent expenses. Those are two different things. Can you open May 2018, question 2A? May 2018, question 2A. Just open the question. Just go through it. Just go through it for a few minutes. Don't do it. Just look at it. I have said May 2018, question 2A. So two, you are told that Mafuta International Limited is a petroleum exploration company. Yeah, Mafuta International Limited, a petroleum exploration company, provided the following financial information for the year ended that 1st of December 2017. There was crude oil exported, so it's 1.4 barrels. Crude oil sold for further refining, 750,000 barrels. Exploration cost, 16 million, that's allowable. Incidental income from petroleum operation, that's other income. Management and admin expenses, that's an income. Depreciation, disallowable expense. Provision for bad debt, disallowable. But specific bad debt is 1.25 million. That one becomes allowable expense. Yeah. Non-productive rent, allowable. What do you mean by non-productive rent, by the way? Now, for example, let's assume you are sent maybe out of your town for job assignment for 2 months. Then you come back, you tell your adult, me hata siku anaishi huko, so why should I pay rent? And I was not living there. Yeah? To be honest, you are not there, right? You are committed somewhere else, but will you still pay the rent? Yes, that's what we call unproductive rent. The schedule of qualifying expenditure was provided as follows. You see that for qualifying expenditure, you provide for investment allowance at the rate of 50%. So we have planted machinery, fixtures, building, pipeline storage. So provide at 50%. Now, location does not matter. Whether offshore, onshore, that one does not matter. Then you are told that additional information. The international market price of crude oil during the year was $12,000 per barrel. The average exchange rate of the US dollar to Kenyan shillings was $1, equivalent to 105 Kenyan shillings. The crude oil sold locally was disposed at 35 shillings per barrel. The tax liability or refund for Mafuta International Limited for the year ended that 1st December 2012, 12 marks. That's a very simple question. Huh? So you can go and attempt, you do it as an assignment, then you mark for yourself. Huh? So the solution is already in your notes, but kindly don't look at the solution. First of all, try, then you mark for yourself. Huh? Evaluate yourself. You can take a 2 minutes break. Then when I come back, now we are done with that handout. Huh? The one for taxation of self-operatorship partnership, we are done with that. I had also shared another document. Now, taxation of property development and real estate. So now that one will take us through for the next 2 classes. Eh? So I'm coming shortly. So we start with that. Eh? That's what we're coming to discuss. So now let's look at taxation of property development or real estates. Taxation of real estate and property development. Yeah, so now in this case, we have some firms who are registered as property developers. For example, if you take a case of maybe, which entity do you know that buys and sells land, they construct houses, they sell. For example, if you take a case of Mivida, Mivida, Saiton, Optiven. You know, for Optiven, if they say land, so land is part of their current asset, not part of non-current asset. Unaulizanga uko na stock, kuna moja iko Juja, kuna ingine iko wapi? So to them, that one is not an non-current asset. That's what they do for day-to-day basis. Are you together? Then you have some entities such as Mivida. They just develop a property and then they sell it. So that means their day-to-day operation is to buy or construct property and they sell. So to them, that one becomes part of the current asset. The only non-current asset they have is where they have the office for long term, if they own it or they have leased it. But what they expect to sell or at least to other entity becomes part of their current assets. So that means that's their business. So how are they taxed? How are they taxed? So cost of the land is always a desirable expense. But to them, you're saying that they are buying land for trading. So therefore becomes part of operating expense. It's in short, it's part of purchases. If you recognize a sale, purchases was part of the cost of sale, which is allowable. So how do we tax them? So open with me, May 2016, question 5B. May 2016, question 5B. May 2016, question 5B. May 2016. Is your May 2016? The one for Mjengo Limited, question 5B. And you're told that Mjengo Limited is a real estate development company. In the year ended that 1st December 2015, the company provided the following information. Bought 100 acres at 6 million each for building low-cost houses in an approved development area. Cost of surveying was 4.6 and conveyance fee amounted to 60,000. The cost of constructing each unit was 1450,000. The company constructed 240 units on a 20-acre piece of land. We read bullet 3 again. The cost of constructing each unit was 1450. That means they have taken into consideration all the costs, labor, material, land, all that. So to us, that is relevant, because all that cost, we have allowable costs and desirable expenses. Then you do that. The company constructed 240 units on a 20-acre piece of land. Let's go back to bullet number 1. Bought 100 acres. So you bought 100 acres. But how much do you utilize to construct the 240 units? 20, just a portion of it. Now let's go to note the last bullet. The costs relating to the total 100 acres are to be apportioned according to the acreage used. Required. Statement of adjusted taxable profit or loss from Jengo Limited for the year ended 1st December 2015. You have Jengo Limited. So we start the revenue. Let's go to the third bullet, fourth bullet. All the units were sold at a price of 1.6 in the year 2015. So we started the sales. How many units did they constructed? 240. Then you are told that the second, that number 4, fourth bullet. All the units were sold and were sold at a price of 1.6 in the year 2015. So 240 units, each at 1.6. So how much was the total revenue? 384,000. Then you raise allowable expenses. Allowable expenses. Let's start with the cost of land. Note number 1. Bought 100 acres at 6 million each for building low-cost houses in an approved development area. But you're told that in the third bullet, the cost of constructing each unit was 1450. The company constructed 240 units on a 20-acre piece. So these 240 units were constructed on a 20 acres, and the cost was how much? 6 million each acre, right? So how much was the total cost of the land, the one utilized to generate the revenue? Is that 120? Sorry, you divide by 100. The 6 million was per acre. So you multiply by only the number of acres utilized, which is 20. Good. Number 2, the second bullet. Cost of surveying was 4.6. Surveying cost was 4.6, and conveyance fee. Now, conveyance fee is the cost incurred to transfer the ownership. If you buy a land, you'll be given the title. So you need to change that title from my name to your name. Who incurs that cost? The purchasing company, not the seller. Are you together? Now that cost you incur, the cost of transferring the ownership of an asset is what we call the conveyance fees. Yeah, so incurred conveyance fee an amount of 69.60. Now, if the incurred surveying cost of 4.6, that means you engage the surveyors to survey what? The land. So they surveyed 100 acres. Are you together? So we need to apportion that cost. So you take 20 over 100. Also conveyance fee. We are transferring the ownership, not of the 20 acres, the ownership of the entire 100 acres. So we need to apportion that cost. So 20 over 100. For 60 times 2, you get 900 and 920. 696 times 2. Sorry? 1392. Then the third bullet, the cost of constructing each unit was 1450. We see that cost is irrelevant. The cost of constructing, that means they have factored all the other costs. Yeah, including the cost of the land, the cost of the material, the cost of labor. But in this case, we're only deducting the allowable expenses. So now that's why you're trying now to partition each cost step by step. Bullet number 5. Building material for constructing each unit amounted to 742.4, inclusive of VAT at the rate of 16, inclusive of VAT. VAT is a desirable expense. That's the money you collected on behalf of the government. So that's not your money. So you have material cost. Material cost. We read again. We are told that building material for constructing each unit was 742.4, inclusive of VAT. So this was per house or per unit. How many units we constructed? You multiply by 240 so that you get the total cost. But that cost is inclusive of VAT. VAT will be disallowed. So to get the inclusive of VAT, you multiply by 100/1. To get VAT, 16/116. That's the VAT. What about the cost? It's 100/116 so that you get the cost exclusive of VAT. So what do you get? Sorry? 153? Sorry? 16. Like that, 153.60. Okay, now let's work with that. Then you're told that Then you're told that professional fees paid to quantity surveyor, inclusive of VAT, was 417.6, and civil engineers was 243,600. Professional fees paid to quantity surveyor was an amount of 417.6, and civil engineers was an amount of 243. Quantity surveyor. Now, what's the work of quantity surveyor? Do we engage him for ad purposes or for houses purposes? House purposes. Are you together? Therefore, this cost, unlike for survey cost, the surveying cost, they were surveying the land. That's why you had to apportion 20/100. But in this case, the quantity surveyor will be engaged only for the building. So that cost is only for the units. Are you together? But this amount was inclusive of VAT. So to get exclusive of VAT, was you take 100/116. Also, civil engineer is a professional fee times 100/116. Yes? 360. The other bullet. Drainage system and sewerage line cost 960 for connecting all units built and to be built on 100 acres. Drainage system and sewerage line 960 for connecting all units built and to be built on 100 acres. So in short, we conducted the drainage system for the entire development, 100 acres. So we apportioned that cost. Drainage system cost. We incurred a total of 900, but we did it on the entire development. So you apportion times 20/100. 96 times 2, you get 190. 192. Interest, the interest on loan to acquire the 100 acres was 7.8. So you have interest on loan. That's the allowable expense. Interest on loan was an amount of 7.8. That was to acquire the land. So that means we are paying the interest to acquire the 100 acres. So we apportion 20/100. 70 times 2, get 15.6, right? Higher expenses for bulldozers used in the construction. This one, we never bought the bulldozers. We hired to use them on a day-to-day basis. If you could have bought, it becomes a desirable expense, but you claim for wear and tear. But in this case, we hired. So that means you'll be paying on a monthly basis. So the rental expense or the higher expense becomes allowable. It's an operating expense. So higher expense for bulldozers used in construction was 600,000 for each of the 3 months used for construction. So you have bulldozer higher cost. It was an amount of 600 for each of the 3 months. So you multiply by 3. You get an amount of 1.8. Yeah. The higher expense for bulldozers used in construction was 600 for each of the 3 months used for the construction. Then we have charges paid to the government in respect of approval plan. Approval plan costs. Yeah, that one related to the units constructed. So an amount of 678. That one you don't have to apportion. They never approved the land. They approved for the construction of the units. Yeah, you argue from that perspective. Cost of constructing the site office. Site office costs. An amount of 800. Also, that one is allowable. Higher cost for Saron car for the site manager was 40,000 per month. Higher cost for Saron car. 40,000 per month. For how many months? For 3 months. You get an amount of, you see, the site manager, you require them during the construction period. Yeah. The way you only had the bulldozers for only 3 months for the construction. Yeah, because that was for the site man. Are you together? It's for the site manager, not the company's manager. For the company's manager, you have to pay him, you have to hire for him every month, for the entire year. But this one for the site manager. So once we are done with that, that's all. The work is done. The work is for only 3 months. Then we have a commercial building was also constructed. A commercial building is not part of this. What does it mean? This one we are building for sale, right? A commercial building, that means we are building it to earn rental incomes. That's an investment property. It's an investment income. So that one does not affect this. And that's how you get your taxable profit. Then we can add other specified sources of income. Let's go to second last bullet. We are told that a commercial building was also constructed at a cost of 5.6 million in the part of the land. The building was rented at a monthly rent of 480 with effect from 1st of May 2015. So how many months to the end of the year? How many months to the end of the year? 8 months, right? So there is rental income. We are told that a commercial building was also constructed at a cost of 5.6 in the part of the land. The building was rented at a monthly rent of 480 with effect from 1st of May 2015. Monthly rent. So it's 480. You multiply by 8. So how much was the rental income earned? That 840. Then you can claim investment allowance on commercial building at the rate of 10%. Can you go to the first page of your first question paper? Yeah, part A, the last bullet. Part A, you have building. For commercial building is how much? 10% per year on reducing balance. Now listen here, explain something. So here, you claim for commercial building. That's what you used to call it IBD, industrial building deduction. So take 10%. How much was the cost of the commercial building? 5.6, you get 560. Then this is what happened. For those expenses to be allowed, you only apportion to the period which the entity was generating revenue. That's from 1st May. If they had rented from the beginning of the year, you claim for wear and tear for the entire year. But when the business was only operated for the part of the year, you restrict, you prorate that. So that means 10% of 5.6, you get the rate for the entire year. Then your portion, 8 over, let me repeat again. If this asset, or assume is a company, and then they bought a machinery, 6 months at the end of the year, you provide for A&T for the entire year. Are you together? Provided the business was operational for the entire year, you only restrict when the business was only operational for only part of the year. So in this case, it was rented, it was okay. In short, we rented this 8 months to the end of the year. So also for A&T, you cannot claim for the entire year. So you only restrict to that period. So how much is that? Sorry? 373. So how much will be the taxable rental income? Sorry? 34? 67. And then if you add the two, that will get the taxable profit. Now, once you get the adjusted taxable profit, now to get the tax liability or tax payable, you just take 30% of your adjusted taxable profit. And go through that for 2 minutes. Then we try another illustration. May 2015, question 1B. May 2015, question 1B. Hoping we are there. Food Contractors Limited is a company engaged in real estate development. On 1st of January 2012, can you underline the date? Underline the date. 1st of January 2012, that's at the beginning of that financial year. On 1st of January 2012, the company commenced the construction of 20 residential houses for sale. Can you underline 20? Yeah, 20 residential houses for sale and a shopping mall for lease. So the residential house, they are for sale. Shopping mall is for lease. So that's an investment property. So they expect to earn rental incomes. So the rental income will be part of the specified sources of income. The construction was on a 5-acre piece of land, and in 5 acres, which residential houses occupied 4 acres and the shopping mall 1 acre. Yeah. So the 5 acres, residential houses, 4 acres, shopping mall, 1 acre. The residential houses and shopping mall were completed on that 1st December 2013. And I need that date, that 1st December 2013. So that means construction took how many years? How many years? 2 years. It commenced on 1st of January 2012. So it's 2012, and then we're told that it was completed on that 1st of December 2013. So it took 2 years to develop them or to construct. Additional information. Additional information. Selling price per house was 18.5 million. You're given all that. Required. First of all, let's go to note number 15. Note number 15. All the houses were sold during the year ended that 1st of December 2014. So that means we are sold upon completion. Assume that deductible cost allowance to be carried forward 2014. Required. A schedule for the year ended that 1st of December. That's 2014 or 2013. Showing number 1, total taxable profit or loss from the sale of houses. Then number 2, taxable profit, rent or income or loss for the shopping mall. So this is Fundi Contractors. Now we start with the sales or the revenue. We constructed how many residential houses? 20 residential houses. Then note number 1. Note number 1, you're told that selling price per house was 18.5. Then you sold all of them at 8.5. So how much was the revenue? 370 million. Then we raise allowable expenses. Allowable expenses. Note number 2. Cost of acquisition of land was 45 million per acre. Cost of land. And we bought how many acres for construction of residential houses? 4 acres. Good. And the cost per acre was how much? 45. So we get an amount of 180. Good. Because requirement number 1, we have to determine the total taxable profit or loss for the sale of houses. It's only concerned with the cost of construction of residential houses. Number 3, materials for building one house cost 3480, inclusive of VAT of 16%. So you have material cost. They told that material used for building one house was 3480. How many buildings we constructed? 20, but was inclusive of VAT. So you eliminate the VAT to get the cost. 100 over 116. 60,000, eh? 60,000. Number 4, drawing for the houses and related architectural design fees were a total of 450,000 net of, that was net of VAT. So drawing related fees was an amount of 450. That was net of VAT, already exclusive. Fees for quantity surveyors, civil engineers, and electrical engineers for the house amounted to 1740, inclusive of VAT. You can call them professional fees. It was an amount of 1740, inclusive of VAT, so 100 over 116. You get? 1,300. 1,500. Number 6, cost of sewerage and drainage system amount to 4840 for the entire development in the 5-acre land. Sewerage and drainage system. Sewerage and drainage, it costed 4840 for the entire development of the 5 acres. So your portion, eh? In the ratio of 4:5. Good. 4:5. 3872. Good. Number 7. A second-hand bulldozer was purchased. So if you purchased, that is not an operating cost. It's a capital expenditure. You'll claim for what? Wear and tear. Good. We'll come back to that. Number 8. A salon car used by the site manager was valued at 800. So at 900 as at that 1st of December 2013. That's after completion of construction. So that's irrelevant. When you're providing for wear and tear, you don't provide based on the revalued amount. You provide based on the original cost. Good. The car had been purchased in the year 2012 at 1.5. 2012, that's when we commenced construction. So now when providing for wear and tear, you will take 25% of the original cost, which is 1.5, not the revalued amount. The car was used in maintenance of the estate and shopping mall. So that means once you determine the wear and tear, you need to apportion. Because was incurred for the maintenance of residential houses and the shopping mall. So you apportion in the ratio of 4:5. So we'll come to that later. Number 9, the labor wages for the construction workers on the entire site was 600,000 per month up to that 1st December 2013. Labor cost. We are told that it's 600 per month. So for how many months? For how many months? Good, 24. Remember the construction started on 1st of January 2012, of which we completed on that 1st of December 20, 2 years. The cost, labor cost per month was 600. So for 2 years, it will be an amount of 20, but this was for the entire development. So your portion 4/5. Good. Was for the entire development. What do you get? 11? 11,520. Good. Number 10. The entire project was financed by ACDC Bank with a loan of 8 million at an interest rate of 10% per annum. So interest on loan is allowable expense. interest on loan. It's 10%. The loan was 8 million. So 10% of 8 million is how much? 8 million. Then you are told that the loan was to be repaid in full on completion and sale of houses. Remember 10%, this is per annum. This is per annum. I told that it was to be repaid in full. The loan was to be repaid in full on completion and the sale of the houses. The loan was granted on 1st of January 2012, and the interest on loan was payable at the end of each year. The loan was, however, repaid in full on 1st of July 2014. Actually, this was for 2014. So how many months? Or how many years? 2012, 2013, those are 2 years. And then was repaid in full on 1st of July 2014. That's 2.5 years, right? So it's 10% of 80, you multiply by 2.5 times. The entire project was financed. That's what we are told that in note number 10. The entire project was financed. So that means the total interest was for the entire development. So we apportion 4/5. 10% of it, you get the interest per annum for 2.5 years. The loan was for the entire development. So you get an amount of 16,000. Number 11. Pavements and roads within the whole estate were built at a cost of 6 million. Pavement and roads, that's what you call, what is that? There's a time I was trying to explain. This building is what you call an ID, industrial deduction, plus other direct expenditure and auxiliary assets, such as lift, water tank, backup generator, perimeter wall, parking, all that. So that means this pavement and roads will be accounted as part of the ID, industrial deduction. So, and the cost of building will qualify at the rate of 50% for the first year. So that one will qualify for ID or investment allowance. Yeah, we know that the pavement and roads within the whole estate were built at a cost of 6. A playground was also constructed at a cost of 840, but to be used by the house owners. So we'll come back to that. That one is provided for wear and tear. Number 12, the shopping mall comprised of shop. So first of all, let's read that. Because in this case, number 1, we have to determine the taxable profit for the sale of residential houses. Shopping mall will be our part 2. Number 13. What is that name? Yeah, estate power line cost 800. Also the power line, the power plant, all that is part of the ID. It's a capital expenditure. So it will be capitalized to the cost of the building. So also it will qualify for wear and tear at 50% for the first year. Number 14, interest on loan is to be apportioned based on the houses and units and shopping malls. The interest on loan is to be apportioned. What is that name? Oh yeah, between the housing units and shopping mall in proportion to the acreage. Yeah, that's what I've been using. 4/5, 4/5. All the houses were sold in the year ended that 1st of December 2014. So now let's provide for investment allowance. Investment allowance. Investment allowance. Now let's start with note number 13. Estate power line cost 800 and covered the residential estate and shopping mall. This is 2014. Are you together? What did we completed? 31st, 30. So that means if you are to sell those units, or you are to rent it out, you rent it from 1st of January 2014. So if you are claiming wear and tear, you cannot claim for 2 years during construction. Are you together? Yes. The only thing you can claim, it's only for maybe the hire of bulldozer tractor used during construction. But this pavement, remember, you only claim from the date you completed. Are you together? But during construction, we have some assets we are using. Now, those assets is what you can claim during that period. So in this case, we have estate power line. At the rate of 50%. That one qualified to be the cost of the building you capitalize. And how much do you incur? 800. Then you multiply by, you do that. Estate power lines, 800. And cover the residential estate and shopping mall, 4/5. 400 times 4/5. 10/5. You get 320. Also, let's go to note number 11. Note number 11. Pavement and roads. So we have pavements, parkings. Also, in case you have backup generator, all of them, they qualify to the cost of the building. They'll be capitalized. Then, yeah, pavement and roads within the whole estate were built at a cost of 6 million. So you take 50% of 6 million. But that one for what? For the whole estate. For your portion, 4/5. Sorry? Sorry? 2,400, 2.4. That pavement and roads within the whole estate were built at a cost of 6 million. A playground was also constructed at a cost of 840, but for the use by the house owners only. So there was playground, 50% only by house owners. How much was the cost? 840. You get an amount of 420. Then we had other assets. Note number 7. A second-hand bulldozer was purchased. So we have a bulldozer. A second-hand bulldozer was purchased for 800,000 and used in large excavation within the entire land. Excavation. Construction took how many years? 2. So you claim for how many years? 2 during the construction. The asset was in use. The playground is after completion. Are you together? But this asset was used in that period. So you claim for 2 years during construction. That is 2012, 2013. Bulldozer, all the self-propelling, they are part of the motor vehicles, and they qualify at the rate of 25%. Can you go back to the first page? Part B of the machinery. Motor vehicle and heavy earth moving equipment, 25% per annum, reducing balance. So this is what you'll do. 25%. How much was the cost? 800. How much is that? That's 200, right? 200. Then you have 2013. 25%. 800 minus 200. What do you get? 150. 150. You get a total of how much? 350. Then you multiply by your portion. What do you get? 280. Also, there was another note number 8. A Saron car used by the site manager was valued at 900 as at that 1st December 2013 upon completion. Is it that that's irrelevant? The valuation does not matter. The car have been purchased year 2012 at 1.5. The car was used in the maintenance of the estate and shopping mall. So the cost was 1.5. So we had Saron car. So 2012, 2013, 25% of 1.5. And that is, this 375. 375. There will be 25%, 1,500. So on reducing balance. 375. What do you get? You get? This is 365. 281.25. And now let's add the total. You add the two. 656 point. Then your portion 4/5. And that's how you get the taxable profit. That's how they determine taxable profit. Part 2 of the question. We have part 2 of the question. Now, part 2 of the question, you have to determine the taxable, the total taxable rental income or loss for the shopping mall. Shopping mall. Let me explain something here. Now, for shopping mall, there's nothing you can claim. Actually, all these expense, which was incurred prior to the renting period. From the date they started, they rented, when the date they started generating income from this shopping mall, that's the only expense you can claim during that period. During construction, Are you together? So now let's go to note number 12. The shopping mall comprised of shops whose construction cost was 1.2. Yeah, that's what we call a commercial building. So you'll claim for investment allowance at commercial building at the rate of 10%. Commercial building now should be at your fingertips. It's at 10%. Yeah, the shopping mall comprised of a shop whose construction 1.2, gymnasium 450, and offices 600. The shopping mall was leased on 1st of January 2014. So that's at the beginning of the year. 1st of January 2014 at a monthly rent of 1.4. So we have rental income. Rental income 1.4 per month. For how many months? So we are preparing a financial statement as at that 1st December 2014. But it was rented from 1st of January 2014. 1.4 was per month. So how much was for the year? Sorry? 16,800. Then you raise allowable expense. Now, when claiming for allowable expenses, you only claim the allowable expenses from 1st of January 2014 to that 1st December 2014. Any expenses incurred prior to, that one does not affect this other investment income. And so I thought that maintenance expenses per month amounted to 400,000. So we have maintenance expenses. 400 per month. For how many months? 12 months. We get an amount of? Sorry? 4,800. The company incurred cost of advertising 400, water meters 180, and electricity deposit of 360 before leasing. That's disallowable expense. Those costs were incurred before leasing. You see, you are advertising before leasing. You are advertising to get the customer. So those expenses were incurred prior to. So that one becomes a disallowable expense. Then ukawekea kila mtu mita yake. It was incurred before. So that one becomes a disallowable expense. What else do you need to claim? Number one, there is interest on loan. Interest on loan. Let's be here. Remember, the loan was for the entire development. The rate was how much? 10% of 80,000. Then you multiply by 4/5. Then you multiply by 6/12. When was this loan repaid in full? 1st of July 2014. But we leased the shopping mall from 1st of January 2014. So how many months went to the repayment period? 6. So you take 10% of 80. 4/5. Sorry, not 4/5, but 1/5. Yeah, should be 1/5. 1/5, you get the proportion per annum of the shopping mall. And then you only apportioned for the 6 months. So what do you get? Sorry? 800. And then there is capital allowance. Capital allowance. We are told that. You see number 12. The shopping mall comprised of shops at a cost of 1.2. You multiply by 10%. See that commercial building is at rate of 10%. So that is 120. Also, there was gymnasium. So there was a gym, 450. So you multiply by 10%. That is 45. Then there was what? Office. 600 times 10%. Get an amount of. That's how you get taxable rental income. So that means when the business now will be filing their returns, this was a taxable profit. Then you have specified sources of income. There was investment income, rental income. Show that amount. Good. I'm sure now you are somewhere. It's good to do some comprehensive question. It gives you a deeper understanding than just doing easier one. So I used to call it a day. We'll do more illustration during our revision on the same. So in our next session, still we'll be using the same document. We'll still be using the same document. So make sure you have a printed one so that we'll be using it for the next class. Can call it a day.